If you can see my screen, if you can hear me, please acknowledge on the chat. Thanks for confirming, guys. All right, let's get started with today's session. Today's session is on portfolio construction and analytics. It's a very, very important domain area in the field of finance. Portfolios are very, very regularly constructed in the asset management industry, as you all know. Various kinds of funds, like mutual funds, hedge funds, involve portfolio construction, uh, optimization, and analytics on the portfolio performance as well, right? So mutual funds are those kinds of funds which are open to the public for distribution. Uh, Retail client with a very small amount to invest can also invest in a mutual fund. On the other hand, a hedge fund is a more specialized fund. It's called as a private fund because the placement can only happen on a private placement basis. Um, Hedge funds typically accept monies of HNIs, family offices, institutions, right? So all the high-end net worth clients typically go to hedge funds because they offer more customized solutions and more, solutions which are more quantitative in nature. So across the asset management industry, portfolio of construction, management, and analytics is a common feature. Not every shop ends up using portfolio optimization, but nevertheless, portfolio optimization and construction is one of the most important things which are prevalent in the asset management industry. Uh, at a retail level, also, you can use portfolio analytics and portfolio construction methods and also optimization methods to create your own portfolios, yeah, at a retail level. So, for instance, if you have 1 lakh rupees to invest and you like 10 stocks, fundamentally good stocks, so how much weightage do you give to each of these? So, questions like these are very easily answered through portfolio analytics, which we will see how to do today. You can keep asking me questions on this chat, right? You have, whenever you have a question, you can keep asking questions here, and as soon as I'm able to see this, I shall be able to answer your questions. So please open your R Studio. So this is how the R Studio looks like. You'll have already done a few codes in R. So this is where I have copy pasted the script. So what I would suggest you is you can click on File. Please click on New File and click on R Script. And this is sort of a notepad kind of a space where you can copy paste your code. And the code will obviously, you can, run some pieces of your code on the console. So let's go to our file, which I shared with you in this file called as Portfolio Construction and Analytics, requesting you to just copy paste this code. It's a 200 odd line code. It's quite a huge code, but let's go through each element that is covered here. Yeah, henceforth, we'll be covering domain applications in R. So for instance, today we are covering portfolio analytics. In the next session, we're going to cover something called as risk analytics. Yeah, so I have basically copy pasted the code script here in the script. And this is obviously my console. This is where I can start running a few files. This is the global environment section where I can see the various variables which I will be defining. So for you, this probably would be blank if you've started a new R session. And obviously, you can access your packages, files, and there's also a help menu for you to understand the usage of different packages and different functions within the packages. So let's get started. I have prepared a PPT for this session. Right. So the first part of portfolio analytics would be uh, first to download data for a single stock and also for a benchmark which we feel is suitable for that stock, or the stock is part of the benchmark, and do a quick comparison between the stock and the benchmark. So this is the first step. So before we actually form portfolios, let's first understand how to build analytics around a single stock, and then we go to the portfolio level. Right. So here we are going to use in this section three packages. One is the quant mod package, which you are aware of, is the package which is very useful for data downloading, data cleaning, manipulation, as well as charting techniques. Right. So this is a very standard package which is used. If you do not have it already, we are going to install this first. We're also going to use two more packages. One is called as portfolio analytics, and the third one is called as performance analytics. Now, these are specialized packages dealing with various functions and methods which can be directly deployed, which otherwise would take 500 to 1,000 lines of code. So, the functions like how to create portfolios, how to optimize them, how to create efficient frontiers, how to find optimal weights. All these kinds of functions are already inbuilt within these packages. So it's important for us to utilize these packages. So the two new packages here are portfolio analytics and performance analytics. A lot of times when you create portfolios, the performance of the portfolios need to be assessed, right? So there are various measures, which can be used to assess the performance of a portfolio. Some common examples are average annualized return on a portfolio, right? So if you want to compare two funds, I will probably go with a fund which has a higher return, yeah, in the form of uh, a higher average annualized return. But just looking at return is not good enough. It's also important to look at what is the kind of risk which a certain manager has taken on the portfolio to earn that return. So hence we look at various risk measures like standard deviation or volatility of a portfolio. Apart from that, there are various other performance analytics or performance measurement measures. Other examples could be something called a Sharpe ratio, which is a risk-adjusted return measure. So we'll be introducing all these in this session today. No worries on that. So that's about portfolio analytics and performance analytics. So I would request you to install these packages and also to load the libraries into R. So for instance, to do that, I'm going to just highlight this section of the code and press Control Enter. And as soon as you do that, uh, you will be asked certain prompts. So for instance, if you QuantMod is already a library a package which I've already installed. So I don't want to restart R. So I'm just going to say a no. So if the package exists already, just click on no. Otherwise, the package will install in the background. So we've not only installed the packages, we also load these packages into a library. Yeah. So what are the various functions related to these packages? So let's see that. So when you go to this feature called as packages here, suppose I want to see what is included in quant mod. So I can very easily click on packages, scroll down, go to quant mod and click on it. And there I will get a very exhaustive list of different kinds of functions related to that package, right? For instance, for those who are aware of technical analysis, QuantMod is one of the popular packages used to plot technical analysis based indicators. They're called as TA indicators, technical analysis indicators, right? So all these are various kinds of functions or methods which can very easily be added to a certain chart. So if you plot a price chart, you can add a moving average, exponential moving average. You can plot something called as oscillators, which are RSI, MACD, etc., etc. So a lot of different functionalities. You can also plot bar charts. You can plot something called as candlestick charts, where every price action on a certain bar looks like a candle. Right? So various things you can do within QuantMod. It's a very popularly used and a very heavily used uh, uh, package. There's also one more very important function called as daily return, in which you can calculate periodic returns. Right? You can also change the frequency of this. If you don't want daily, you can also make it as weekly or monthly. So the frequency can be specified. There are other packages also, which through which you can calculate return, which I will introduce later. And if you want to find the peaks and valleys in a certain series, you can use these functions called as find peaks, find valleys, right? So these are some of the very useful kind of functions within QuantMod. And one of the most popularly used is obviously something called as get symbols, where we will load and manage data from multiple sources. So one of the most commonly used sources for us would be Yahoo, from which we will download various kinds of stock level information, right? Stock price information. So this is a bit about the quant mod package. The other package which we have just installed and we have loaded in the library is portfolio analytics. So let's see what is part of that. So I go to this package, click on that, and just scroll down. And as you can see, there are various portfolio level optimizations or functions or methods which are available. So, for instance, there's this popular model which you will probably learn uh, when you pursue a master's or when you work in the industry. It's called the Black-Litterman model. It's basically a reverse optimization problem where I give the mean and the standard deviations and then ask basically what should be the weightages, right? So it works in a reverse manner. You can also specify your own specifications. If you are overweight on certain sector or underweight on certain stocks or overweight on certain stocks, you can give those specifications and automatically implied returns will be calculated, right? So this Black-Litterman model is basically to calculate implied uh, uh, implied returns and hence the new weights which arrive, the implied weights through your portfolios. There are various other kinds of functions. Today, we are going to use something called as chart.efficient frontier, which is used to chart out something called as an efficient frontier. I will tell you very soon what an efficient frontier is. So all domain related information about what is portfolio construction, I'm going to cover very briefly in this PPT also. But I just wanted to show you that this package, Portfolio Analytics, covers a lot of different kinds of functions related to portfolio building, right? You can do a lot of risk reward analysis, risk budgeting analysis as with regards to your portfolio. You can do a lot of optimization with respect to your risk reward. You can also find weights and chart out your weights of your portfolio. So once you run an optimization on your portfolio, the new weights will be thrown up as an output, and those can be very easily charted using this function called as chart.weights. So these are some of the important functions which we're going to use. If you scroll down, lots of other things. So you can add constraints to your portfolio optimization. What is a constraint? So constraint could be that the sum of all the stocks in my portfolio should be equal to one, which means that I do not take leverage. It means that whatever I have money to invest, I invest fully in a portfolio of stocks, right? So the sum of weight should be one. Also, the weight of any stock should always vary between 0 and 1. So you can add these kinds of constraints very easily through this package, which is called as Portfolio Analytics. So we'll definitely look at some of these things. It's a very exhaustive package, but particularly it's used to plot efficient frontier, which is basically a risk return graph for a certain collection of portfolios, and it's used to find optimal weights, run optimization, and also plot these optimization outputs. Yeah, so these are some of the basics on portfolio analytics. Performance analytics. Let's see what this package has. I go to performance analytics, click on that, and you see that there are various kinds of performance analytics like Sharpe ratio, drawdown, active return, right? Lots of other things like beta, etc., etc. CAPM beta, CAPM alpha, CAPM beta bull, beta bear. We are going to study all of this today. No worries on that. Uh, CAPM Jensen alpha, right? So all these are various kinds of performance metrics or analytics which are included in the form of performance analytics. So the best part is that you do not have to remember formula and write formula every now and then. So you do not have to write functions. These functions are already pre-created and are part of the package called as performance analytics. Any questions till now? I hope you've run these first 6 lines of code and you've installed these 3 packages and loaded them into your library. Okay. I will repeat the copying part. So there are various ways of copying. One way is, uh, uh, first of all, put your code out here, which is in your notepad. You can Control A, Control C, put it out on your script here, script section. And one of the ways of copy pasting it onto the console is actually selecting first, pressing Control C, and then copying it here through Control V. That is one way. But an easier way is to select multiple lines and press Control Enter. When you press Control Enter, whatever lines you've selected will automatically run. And another way is you can select the lines and click on this run. So there are three various ways in which you can run your code, which you have loaded onto your script. Hope I have answered that question, Ashutosh. Any other questions before I continue? So hopefully you have installed these three packages, loaded them in your library. Let's proceed. Let's go towards understanding how to first load single stock features. So this is a snippet of code. Uh, I'm going to explain every line here, what is going to happen in this code. So this is for the single stock. So what we do is we assign a certain date. So this is basically a start date, which we'll be using in the function called as getSymbols.yahoo. So what I'm doing is I'm assigning a start date. You can assign whatever start date you want. I will be constructing my portfolio from the start date. So this is basically a start date. If you do not assign an end date, it's assumed that the end date is today, right? So by default, the end date is assumed to be today. So once we assign the variable dt as some kind of a start date in double quotes, you have to give it a proper format. The next thing is we are going to download data, which is Facebook data, right? So this is the stock Facebook, which is traded on NASDAQ. Its symbol is FB. Yahoo symbol is FB. So we use that Yahoo symbol FB. And what we do is we use the method getSymbols.yahoo, in which we first specify the symbol. Then we specify the date from which we want to start. So I'm assigning dt from equal to dt, which I've already defined in the previous line. And then auto.assign is equal to false. Right? So these are the arguments for your getSymbols.yahoo, right? So symbols, you can give one symbol or a collection of symbols here, right? You can also give a vector here instead of one symbol. Environment is where you want to create these objects. So by default, it will be stored in the global environment. What is the global environment? Global environment is basically this. So when you click on environment, all the new objects which you will be creating here will be loaded into your global environment. So that's the meaning of env. So these are the various parameters or arguments which can be passed into getSymbols.yahoo. Obviously, you do not have to use all of these, but you can use the most important ones. So we are also using something called as auto.assign is equal to false, which you have seen in the past. Basically, it tells us whether the result should be loaded onto the environment or not, right? Then what we do is we calculate. So once we retrieve getSymbols.yahoo, the Facebook data, typically the data is in the OHLC format. So there'll be a date, there'll be an open price, high, low, and close price for that date. So all that information gets stored in this variable called as FB. Yeah. Suppose I'm only interested in fetching the adjusted closing price. I rather give this format, which is close bracket comma 6, right? Which means it only extracts the sixth column from FB and assigns that value to FB adjusted variable. Now let's see why are we using comma 6. For that, I would request you to first run these two lines of code. I'm running these two lines. And once it's done, as you can see, it's already done. So FB is the object created in my case. If you want to understand what is FB, you can type FB, press enter. And as you can see, you'll not be able to see the headers here. So to see the header or the first few lines, you can just type a head of FB. And then you can see the structure of this object FB. Basically, the first column is the date, and then you have the open price, high, low, close, volume, and adjusted. So this adjusted closing price is basically adjusted for dividends, stock splits, demergers, etc., etc. Right? So all those are basically adjusted into the price. Any questions so far? So what I've done simply is I've assigned start date to the variable dt. And then what I've done is I've downloaded Facebook data, and I'm just using head FB to understand how my headers look like, or the first few lines of my data set. And then what I do is I am going to just extract the sixth column. Why sixth? Because adjusted is the sixth column in the scheme of things here, right? So hence what I'm doing is I'm saying extract all rows. Hence this is blank, and then I give comma and I give six, which is the sixth column. All the rows in that sixth column should be extracted, and it should be made a part of, assigned to this variable, which is called as FB adjusted. So let's run this, guys. So I'm going to select this, control enter. This is run. If now you want to see how this looks, sorry, I should type it here. And then what I do next is I start typing head of FB ADG. And as you can see, what we have done is in this variable FBADG, we've extracted the uh, adjusted closing prices for Facebook. Right. So I would request you to please complete till here. Any questions, please ask. Right. So we have assigned FB adjusted here. So the next thing to do is obviously to calculate returns. So for that, let's see, the next line is to calculate returns. So we are storing that in a variable called as FB returns. And the syntax basically says that you use a function called as daily return. Now, what I've done is I have given the snapshot of what daily return means. Suppose you're not able to understand any of these functions, the best way is to load that, uh, to ask for help on that. For instance, if I'm using daily return, I can start typing that, and as soon as you type, whatever functions are available for packages which you have loaded will be listed out here. So I can do double click on daily return, and this is the usage of daily return. So it's part of something called as period return, wherein period you can either mention like this as a parameter, or you can also use a new function. Instead of period return, you can write daily return. And similarly, you can calculate weekly, monthly, quarterly, annual returns very, very easily. Yeah. So these are various ways of calculating periodic returns. So in our case, we are using something called as daily returns, right? So this is that function which calculates daily returns out of the FB adjusted price, which is the Facebook adjusted closing prices. If you see, there is something called as type here. So what is type? Type basically tells us what kind of returns do you want to calculate. There are basically two types of returns. One are arithmetic returns, and the other are log returns. So log returns are used when you have something called as a daily compounding mechanism in place. Arithmetic returns are used when you have no compounding, right? So in most of the funds, what happens is whatever profits are made, they are basically reinvested into the fund. If the profits which are made are reinvested into the fund, so there is basically compounding of profits which are reinvested. So your principal amount keeps getting higher because you're reinvesting profits back into your fund, right? So most of the fund houses typically use log returns because that's the appropriate way of calculating daily returns, right? But you can also use something called as type is equal to arithmetic, right? So daily return has two important parameters. One is the series of which daily return you want to calculate, and the other is what type of daily return you want to calculate, whether it's log or arithmetic, right? So it can be very easily specified here. And then over this, what we do is we apply a method called as na.omit, which basically means that we are going to omit all kinds of NA items or NA rows from our daily returns so that we can apply any kind of statistical analysis on this time series. Because if your time series has NA data, it's very difficult to summarize that data, right? So most of the time, the summaries come out to be NA as well. So hence, it's important to use something called as na.omit. Yeah, so we are going to apply these few concepts right now. So the first thing which we are going to do is we are going to apply something called as, we're going to calculate returns now. So let's calculate returns. I'm going to control enter this line. So FB returns. Let's see how this looks like. So once again, I type head of FB returns, enter. As you can see, these are all the daily returns for Facebook, which are now calculated. And it's stored in this variable called as FB returns. We can also calculate FB returns 1, so wherein we are using arithmetic. So let's also see how that looks. And what we'll do is head of FB returns 1. As you can see, slight difference between the calculation of the two. So for instance, here it's minus 1.8%, here is minus 1.79%. So the two outputs will differ because of compounding issues, right? NA is not available. So if there is a value which is not available in your data set, that appears as NA. So you got to remove all those kinds of values which are NA values from your returns, so that then you can compute summary statistics, or you can, describe your returns or use that to create portfolios later. So it's very important. This step is very, very important to omit NA values, right? So that's what NA stands for. The next set of lines, so we are done with these few lines. The next set of lines typically deal with how to chart. So we're going to use a function called as chart series. Now you must be wondering, what is this function? So this function is basically used to prepare professional charts out of your data sets. So for instance, let's see what this chart series is all about. So what I've done is, on the next slide, I have explained what chart series is. So chart series takes a lot of different kinds of parameters. So here, if you see, we are only passing what? We're only passing the price here. So for instance, we've passed Facebook price, we've passed Facebook adjusted price, and we've also passed something called as returns for Facebook, right? But if you see, each of these functions are only using one parameter, but actually in theory, you can use lots of different kinds of parameter. For instance, you can use something called as bar dot type. If you want to create candlestick charts, you can use that OHLC kind. If you want to create a line chart, you can say line dot type is equal to 1. Log scales, if you want to use log scale, if you do not want to use log scales, you can always specify log dot scale is equal to true. So that will enable the log scaling mechanism. So a lot of different things you can use. Show dot grid is, if you want to see grid lines into your chart, you can make it true, right? So these are by default the various kinds of default parameters. So if you don't specify these by default, these values will be taken. So then there's also called as TA. TA is basically technical analysis. You can add various kinds of technical analysis indicators or methods here very easily, right? So various kinds of things you can do here. And I've also explained each of these different things. What do each of these different parameters do? So TA, for instance, is the vector of technical indicators, etc., etc. A time dot scale is what kind of time scale do you want to use. Log dot scale is if you want your y-axis to be log scaled or not. Show dot grid, I've already explained, showing price grid lines or not. Name is, if you want to give a certain name to the chart, you can give it through this. Name is equal to whatever. In double quotes, you can give the name to the chart, right? And a lot of themes also you can, so suppose you want to use a black theme, you can specify theme is equal to chart theme black, and so on and so forth. You can also give colors to your candles or bars. So if the price is going up in a certain candle, you can give it a color using up dot call is equal to double quotes green. For a price down movement on a certain candle, you can give it a red color, and you can specifically define dn dot call is equal to double quotes red. So all these are very, very advanced things. You need not know all of these things, but I still thought I should just place it on the slide for you to understand what are the various features and parameters which you can pass into this chart series. Let's now load these charts one by one. So for instance, I'm going to start loading this chart series FB. Let's first run this. And as soon as I run this, you can see this beautiful kind of chart, which is visible here. So it's very different from the normal plot which you use as part of ggplot2 package, because here, as you see, there is volume, there is price, and appropriately dates. So it's a proper chart which you see for a stock price movement, right? So this is generally, this is the kind of chart which you see when you when you load a chart from a broker terminal, or when you access charts from free open sources, when you analyze charts. So this is the typical format. So this the spirit of that format is retained, and hence we do not use plot function, we use chart series, because the format of the output of the chart series is very similar to what you see in the real world, right? So I wanted to just throw upon some light on this chart series method. So if you want to know more about this, you can go to help and you can start typing chart series. And as soon as you start typing this, you will get your. So for instance, chart series is part of quant mod package. And here you can use various kinds. You can create financial charts. So this is a specific package method rather, or a function to create financial charts, right? Mostly price charts, and technical analysis indicators can also be very easily woven into this. Let's go to the next set of codes. So I have also put out the outputs, which is like this. The last thing remaining is to plot the returns. Let's see how the returns look like. So for that, I use this line of the code, press Control Enter. So chart series FB returns. If you remember, FB returns was the line where we calculated daily returns of adjusted Facebook prices, assign that to FB return. So we're going to use that variable and going to chart that out. Very interesting chart. If you see this last set of data is for the last 6 months. If you see that on a particular day, Facebook fell 10%, Facebook also fell 15%. And this is typically that period in which COVID started, in February, March. If you remember, uh, equity markets across the world tanked. Most of the stocks in the various indices fell anywhere from 30 to 70%. And you can clearly see that a lot of drawdowns if you would have invested in Facebook in that period. So yeah, so this is basically a simple plot which helps us understand how the returns look like. And obviously, you can see more up bars here, because if you remember from, or if you follow markets from end of March or from April onwards, there has been a kind of a bounce back in the global markets because of something called as quantitative easing, which is globally various kinds of central banks have started printing money, have started bringing down their yield curves on the longer term edges. So the longer ends of the yield curves have gone down, so that it incentivizes various businesses to reduce their cost of borrowing, so that they can borrow at lower yields or lower costs from the market. So the why the markets have kind of risen, which is what you can see, that more spikes on the upside rather than downside. If you see Facebook in the last few months from April, typically, right? So the reason is quantitative easing. The reason is also that some kind of vaccine will come out. So hopes of a vaccine very soon have all led to a recovery in global markets. So this is how I analyze, and this is how I plot various kinds of charts related to prices or related to returns. Any questions, anyone? Please feel free to ask. All right. So we are done with the single stock features. Let's go to the next part, and we will do similar kinds of codes where we will uh, download the benchmark information. So the benchmark information is basically the S&P index here, right? So what we're going to do is we're going to download information on this index, which is given by a code called as Yahoo symbol called as slash GSPC. And we are going to download data from the same date. Periodicity will be daily in nature. And if we are also going to extract only the adjusted closing prices of that index, assign that to benchmark prices. And again, apply something called as daily return on that benchmark prices, uh, omit all the NA values and assign that to the benchmark returns. So essentially, we'll be having two series. One is called as FB returns, and the other is called as benchmark returns. FB returns stores the returns for the single stock, which is Facebook, under consideration here, and benchmark returns stores the return series for the benchmark, which is the S&P index. And what we do next is we calculate the means and the standard deviation. Standard deviation is basically stock volatility of these two so that we can compare. And as you can see, this is the output of that. We will very soon run these lines of code. If you analyze the output, you see that FB, the return, daily return for FBs is almost double as compared to the S&P 500, which means Facebook in the period from 2017 onwards till now has given a double return, double daily return versus the benchmark under consideration. Also, if you consider the risk of investing in Facebook versus benchmark, clearly the standard deviation for Facebook return is far higher as compared to benchmark. So clearly, uh, typically also this is the case across the industry, across the asset management industry. If you want to earn more return, you need to you need to take more risk, and typically, that is what is also illustrated here clearly through the analysis. Facebook is making more return, but at the expense of more risk. And hence, we need to go beyond return and risk and see something called as risk adjusted returns, right? So, an example of risk adjusted returns is something called as a Sharpe ratio, which we will come to later, right? We've also used something called as call sums method. So call sums method is basically used to understand the counts or the means for various kinds of numeric arrays or data frames in which you want to calculate, for instance, how many columns are giving NA values. So for instance, here we are trying to calculate the number of columns which are NA in the benchmark prices which we have downloaded, right? It's not really needed, but I thought I should just introduce this new function called as call sums. So the next thing would be to implement those certain lines of code. So for instance, I'm going to first download the benchmark prices. First up, I'm going to run call sums and I'm going to calculate the benchmark returns using similar techniques and just press Control Enter to load these into my. So benchmark returns is now calculated. How it looks, let's see, head of BCH. You need not type the whole thing. Best thing is that there is auto typing here, which means once you start typing the first few letters, you can very easily select what you want from here. So for instance, I want to see what is happening in benchmark prices. I want to see head of that. So as you can see, GSPC adjusted prices. So these are the S&P 500 adjusted prices from 2017 onwards. And then if you want to see what is happening rather in the benchmark returns, so let's start typing that. Let's enter. And these are the daily returns for the benchmark. Yeah, so what we have done is simply downloaded S&P 500 daily data, converted that into returns, omitted the NA values, type we have assigned as log returns. And the next thing to do would be to calculate the mean and standard deviation, which is the returns and volatility of the stock and the index. So we are going to just control paste, control enter. So these are the two means. If you remember, this is what we saw on the output here. And the volatility, stock volatilities are these. Right? So the functions are mean and SD, very, very, very easy functions to remember also. Any questions, please ask. And if you're keeping pace with me, if you can just acknowledge it on this chat, it will be helpful for me to understand that you are with me, you're able to understand me and keeping pace with me. So if you're able to do it till here, kindly just acknowledge that on the chat, please. So we've calculated mean and standard deviations for the stock as well as for the benchmark. And this is the summary of how that looks. Thanks for acknowledging, guys. So we are done with downloading the benchmark level information. The next thing which we will do is learn about something called as, so this is the first portfolio analytics performance measure called as beta. What is beta? Beta, typically you can understand beta as an output of regression, wherein your X variable, which is your independent variable, is the market return, right? Or the index or the benchmark return. And the Y variable, which is the dependent variable, the dependent variable is nothing but the stock return. So I'm regressing market return over stock return, right? And the slope which I get, or the coefficient for the independent variable, is basically a beta. So this is a practical way of calculating beta. The practical way is running a regression where I regress market returns over individual stock returns. And the slope which I get, or the coefficient which I get for the independent variable, is basically my beta. What does beta mean? It basically helps me understand the elasticity of the returns, stock returns versus market returns. So it's basically a measure of sensitivity. It helps me understand that if market moves by 1%, how much does the stock move by? So suppose stock beta is 1.2, it means that if market goes up by 1%, the stock goes up by 1.2%. And vice versa, if the market goes down by say 2%, if say RM is minus 2%, then RI will be basically so sorry, RM is minus 1%, and if the beta of the stock is say 2, then RI will be minus 2%. So depending on the beta level of the stock moves. So once again, I repeat, beta is basically a measure of sensitivity or elasticity of the stock returns versus market returns. It basically tells us if beta is equal to say 3 for a certain stock, it means that if the market is moving up by 1%, the stock is moving up by 3%. Vice versa, if the market is moving down by 1%, the stock is also moving down by minus 3%. So betas of more than one basically mean magnification of price movements of the stocks, right? So highly sensitive stocks to the market or highly volatile stocks typically will have betas more than one. The beta for the market is one, and stocks which have beta less than one are less prone to market movements, and hence their betas are less than one, right? Typical examples of beta being less than one are defensive sector companies, FMCG companies, large caps, some of the large caps, and insurance companies. So these are the some of the sectors which might have beta less than one, not necessarily. Okay. Any questions on this concept of beta? And what we've done is we've given a simple example here, right? The example is saying that the alpha is so and so. Alpha is basically a constant coming out of the regression. The beta comes out for this regression as 1.05. Suppose given that ABC stock rises by 3% during a month, in which market rose by 1.25%, what is the abnormal return on ABC? So if you see, there's an error term here, which is basically the abnormal return, right? So abnormal return is nothing but actual return in the stock minus the expected return of the stock. The expected return of the stock is alpha plus beta times RM. So that's what we are finding here. Expected return on the stock is nothing but alpha. This is alpha plus beta times RM. RM is nothing but the return of the market in that certain month. So expected return for the stock was 1.5%, but the stock returned how much? 3%. So can I say the stock is actually giving more returns than the expected return, and hence we say that the stock generated something called as an alpha in the market. So if this term, this error term is positive, it means that the stock has outbeaten its expectations. If the error term is negative, it means the stock has underperformed expectations, right? So that is how you read this equation. It's basically a regression equation. It's also called as an index model in the portfolio management theory. So this model, this specification is called as an index model. Any questions, guys? Please feel free to ask questions related to related to the domain. So this is beta. We have a few more slides of beta. This is the statistical definition of beta. So beta is nothing but covariance of RI comma RM, which is nothing but stock return and market return divided by variance of the market return. And if you simplify the definition, use the definitions of covariance and variance, it basically boils down to this formula. So the second way of calculating beta, first way was to use regression, to run a regression of the benchmark over the stock returns, the benchmark returns over the stock returns, and use the slope. So that was the first method. Second method could be that you use this formula, right? So you can also use this formula. I will not get into the details of this example, right? So this is typically an example of how beta is calculated through regression. So clearly, when you run a regression, you're basically running something called as OLS regression, which is ordinary least squares, wherein your optimization function is basically minimizing the distance square of each of these points from this certain kind of mean line which passes uh, through these dots or plots, right? So this is nothing but a scatter plot of your daily returns, security versus market for various days, and you're trying to basically do a curve fitting here in the form of a linear curve. So that's how typically a regression is done. The optimization for the regression will be the minimization of the error term square. Error term square is nothing but the distance of any return from this line, which is nothing but the optimized line. Right, so that's an explanation of beta. So I hope that was useful to you. So the next thing which we do here is to calculate beta, which I will now explain. So how do we calculate beta? So let's see. So once again, there are three methods which we use in our R code. The first method is using a regression. As you know, a regression in R is given by the method lm, and there on the right side of this hash, what you do is you give something called as the independent variable or variables. In our case, it's the benchmark returns, and the dependent variable is basically the Facebook returns or the stock returns. So I'm regressing benchmark returns over stock returns, as you can see. I can summarize the output of the model. I'm storing the output of this regression in a variable called as model, and then I can summarize the model using summary of model, and then I can specifically call out the coefficients 2. Coefficients 2 basically is the slope, right, uh, of the output of this model. And I'm assigning that, I can assign that to a variable. So this will be basically beta using the first method, which uses regression. So this is the first method of regression. The second method is the formula, which I showed you some time back, in which you can use that covariance divided by variance formula, which is broken down into this simplification. So that's the second method. Third method is actually using something called as a system defined function, rather a package defined function. So there's a function called as capm.beta, which you can use, which uses three different parameters. The first parameter is the stock returns, or the second parameter is the benchmark returns, and the third parameter is the risk-free return or the risk-free rate which you want to assume. So for instance, in our case, we are assuming that the risk-free rate is 2.5%. This is on a trading basis, right? So the daily risk-free return needs to be calculated, because if you remember, all these returns are that we're calculating is on a daily basis. So what we do is we take the risk-free rate and we divide it by the number of trading days, which is 252, and hence we find the average daily risk-free return, which is generated on a trading day basis. So number of trading days in a year are 252. Calendar days are 365, but the number of trading days typically are 252. So that's what we take here, and we are going to apply. We can also apply this third method called as capm.beta. So let's apply these three methods and see how to calculate this first portfolio analytics, which is called as beta. So for that, we go to the next part of our code. We use this method one. Let's do step by step. So suppose I press Control Enter. So I have run the model now. So I've run the regression model to calculate beta. Let's see what the output looks like. So I go to summary model. I go to the end of this line and press Control Enter. And as you can see, this is the output of that. So the output of the regression, as you can see, this is the residual information, min, max, a median, first quartile, third quartile, etc., etc. Coefficient, this is the intercept, and this is the benchmark. Sorry, this is the coefficient of the benchmark, 1.058, right? So this is typically what will be the output which is required, which is 1.058 for the stock, right? So this is the estimate. The first is for the intercept, which is the constant, and second one is for the independent variable, which is benchmark returns. So this is the coefficient of that or the estimate of that. So this becomes your beta. So how do we take this out from this information of the regression? We basically use this simple line of code where we say take out the second coefficient from this model, and you can do that very easily. And what happens is that this estimate can be very easily extracted out of this regression output. So this is the first method of using beta. The second method is you can use this tedious formula, which is very difficult to remember unless you are well versed with portfolio theory. So this is the least useful method, but I still wanted to show you how to do that. So it kind of matches with the previous output as well. And the third method is using this function called as capm.beta. Now, what is this function? Let's go into help. So I have kind of given you a, a brief of beta, but what is this function capm.beta? So let's load capm.beta here. And as you can see, I've already explained the three inputs of this: RA, RB, and RF. RA is the stock return, RB is the benchmark return, and RF is the risk-free return. Right? So you can very easily use something called as capm.beta instead of running a regression, which will easily help you understand and calculate capm beta. So let's do this. Before I calculate capm beta, I need to assign 2.5%, which I'm assuming to be the annualized risk-free rate. First of all, let's assign that to a variable called as RF return, and then we can run capm.beta, and I get an output 1.058. As you can see, it matches with the previous two outputs, which means the three methods are equivalent to each other. So I would request you to please complete it till here. I'm going to take a short break of around 5 minutes. We'll come back and we'll continue with the other parts of this code. All right, guys, let's continue. So we just saw how to calculate beta and what is beta. And the outputs from the three methods also match to each other, which is good. One more thing which I wanted to introduce was something called as calculating the annualized returns of the stock as well as the benchmark return and returning that in the format of a table. So the most three important characteristics of any portfolio are its returns, are the risk, which is standard deviation, and the third being the Sharpe ratio, which is nothing but the risk adjusted return, right? So let's look at this method called as table.annualized returns. It's part of so if you just click on table.annualized, sorry, all caps, it's part of the package which we installed first up called as portfolio performance analytics, and it helps you to get data in this format, which is basically return, standard deviation, and Sharpe ratio, right? If you want to specify a certain risk-free rate, you are free to specify that by putting a comma. RF is equal to whatever risk-free rate you want to specify. If you do not specify a risk-free rate, it will assume that the risk-free rate in your portfolio is 0%. So let's quickly calculate this. As you can see, these are the three attributes, important attributes for the stock. And then what we do is we also calculate the same for the benchmark. So if you see the stock versus the now, if you compare how did Facebook compare versus the benchmark S&P 500 on a longer term basis, which is annualized basis, you see that the average annualized return is 17.4% through Facebook, but it is 10.3 on the S&P 500. So Facebook is beating S&P 500 in terms of returns. The risk is far higher because 34% risk in Facebook versus 21% risk on the benchmark. So it's a riskier stock versus the benchmark. But if you see the risk adjusted return, which is called as a Sharpe ratio, the Sharpe ratio for um, Facebook is slightly higher as compared to the benchmark. So if the Sharpe ratios or the risk adjusted returns are the same, I will basically choose a stock which has higher returns. So instead of investing in the S&P 500, I'm going to invest in Facebook because the risk adjusted returns historically are the same, but Facebook is giving me far more return versus um, the benchmark S&P 500. So this is how I read the output from table.annualized returns. It's a very, very good method or a function which directly helps us calculate uh, uh, three important portfolio analytics measures called as return, standard deviation, and Sharpe ratio. You can also try this out. I've tried out these two lines called as table.analyzed FB returns and benchmark returns. This is the explanation of this thing which I just introduced called a Sharpe ratio. So what is Sharpe ratio? Ratio is basically a risk adjusted return. So on the numerator, you have RP minus RF, which is basically portfolio return minus risk-free return. Or you can also have stock return minus risk-free return. It basically tells me how much excess return I've earned over the risk-free rate. So, for instance, I can invest in the government bonds, or I can invest in high quality banks FDs and get returns which are called as relatively risk-free returns, right? Especially if I invest in government securities or in treasury bonds, US treasury bonds, they are almost risk-free. But if, say, the risk-free rate of investing in treasury bonds is 2%, and as a portfolio manager, I returned only 1%, I'm actually, even though my return is positive, I'm underperforming the risk-free rate. So it's hence very important to understand what is the return of the portfolio over the risk-free rate. So it's called as RP minus RF, and you divide that by the volatility of the stock or the portfolio. So you're normalizing the excess returns by the volatility. So this is very similar to a measure called as the inverse of the coefficient of variance, if you've heard of that, or if you've done that in statistics somewhere. So this is the inverse of that. It's given by excess return divided by the standard deviation of the portfolio. Right? So we have a simple example here where we have three managers, we have the market, we have the risk-free rate, we have the returns, we have standard deviations, we have betas for the three managers, and you need to calculate the Sharpe ratio. Yeah. So Sharpe ratio for any manager is calculated like this: return generated by the manager A minus risk-free rate, which is 4%. So 13% minus 4% divided by sigma A, which is the risk of manager A. And then we compute Sharpe ratios, and clearly which manager is the best. Manager C is the best on a risk adjusted return basis, because the Sharpe ratio for manager C is the best. So C gives superior risk adjusted matrix or returns versus other managers. So that's how you read Sharpe ratios, that's how you analyze Sharpe ratios. So these are some of the slides on helping you understand what is a Sharpe ratio. And that's exactly what we have calculated here as part of this method called as table.analyze returns. There are a few more things which can be calculated. So there's something called as Jensen alpha, which basically is what is the excess return that you generate over your expected return, right? So that's called as Jensen alpha. This is something which I've already explained to you. So what is the excess return earned over the expected return in a stock? So I think we have. So there's a method called as CAPM.Jensen alpha, again part of the portfolio analytics package, in which you can give as an input the stock returns, the benchmark returns, or the portfolio returns and the benchmark returns, and also specify the risk-free rate. And you can very easily calculate the alpha generated in the stock. So for instance, let's do it for Facebook. So the alpha generated for Facebook is nearly 6.5%. So massive alpha earned over the benchmark, right? So anything positive means the stock has outperformed its own expectations and outperformed the benchmark. Anything less than zero means the stock has underperformed its own expected returns. Yeah, so that's how you read this figure called as Jensen alpha. You can also calculate Sharpe ratio using Sharpe ratio.analyzed, but it's already part of table.analyze returns. But you can specifically also calculate Sharpe ratio independently. So this is the Sharpe ratio, 0.42 for Facebook. By assuming a risk-free return of 2.5% per annum. And then you can also calculate the table returns once again. So table returns are return, standard deviation, and Sharpe ratios once again. I just wanted to, show you some more performance analytics of a certain portfolio. So once again, we just saw beta, we saw Sharpe ratio, we saw something called a Jensen's alpha. And these are some of the most important performance metrics or performance analytics. And this is how the output looks like. This is an explanation of Sharpe ratio. We've seen that. This is the explanation of Jensen's alpha. It basically means what is the excess return earned over the expected return. Right? And we have a small example showcasing how to calculate that. You can go through this later on in your free time. The next part of the code deals with downloading information or stock price information about another company, in this case, Apple. So what we're doing is downloading information about Apple, storing that in a variable called as AAPL. And then we specifically take only the adjusted Apple prices and assign that to the variable Apple adjusted. Then we calculate returns on Apple using log returns using this function called as daily return. We omit all the NA values. We chart out the series for Apple, Apple adjusted, and Apple returns. Calculate the stock volatility as well as benchmark volatility using the SD function. And then calculate the various portfolio analytics measures. So the first measure is the stock beta. We use the function as well as we use CAPM.beta function, right? So using the formula in this method, and we also using the function called as capm dot beta. And then we head out to uh, you know uh, give us the summary of the most important analytics, which is return, risk, and Sharpe ratios, using this function called as table dot annualized returns, which we've already seen some time back. And then we move ahead to calculate Jensen's alpha. We also calculate Sharpe ratio individually, and then summarize all the information using table.analyzed. Right. So what I'll do is I'll run this entire code together, because this is just a repetition for what we did with Facebook. We're using the same set of codes, but for Apple now. So I go back to my code, and I just copy the relevant items till here, and I press Control Enter. And then what happens is the information gets stored in the various variables called as Apple returns. And as you can see, there's this plot which gets plotted out here called as Apple returns. And as you can see some very negative values here, which was because of the pandemic breakout in February, March. And then a few values which are highly positive in this period, which is because of the recovery in the markets from the end of March or early April. So this is so what we've done is we've extracted information and analytics on Facebook and Apple, and now the next step will be to start forming a portfolio, right? So I'll just wait here for a minute for you to finish doing this for Apple, and once you're done with this, we can continue for portfolio. And please start acknowledging RF return cannot be found. Okay, so RF return is something which you need to first specify. For instance, this is the definition of RF return. Without this, you cannot use the variable. So you need to specify this variable called as RF return and assign it a value 2.5% divided by 252. It gives you the daily risk-free return based on trading days. Brilliant. Any other questions till here? Please feel free to ask me. So what we've done is we have looked at uh, downloading analytics for Facebook, downloading price information and calculating analytics for Facebook, then for Apple. And now we'll head out to create a simple small portfolio of 4 stocks, right? So the 4 stocks under consideration are Facebook, Apple, Amazon, and Netflix. And let's see how to create a portfolio and how to arrive at portfolio level analytics now as the next step. I'll wait for a minute here for you to ask me questions and for you to finish whatever I've done till now. All right, let's go to the next step, guys. The next step would be to start forming the portfolio. So I'm going to go on why form portfolios. So portfolios are basically formed to achieve diversification in your stocks that you invest into. So collection of stocks is called as a portfolio, and when you invest in a collection of stocks, you achieve something called as portfolio diversification. So this is a very, very simple example. This graph basically tells us that if I increase the number of stocks from 1 to 20, what happens is that the variance in my portfolio starts reducing. And as you can see, if I have just one stock, the variance is very high because the risk is very high. But if, say, I have 1 lakh invest in one stock, the risk is very high. But if suppose I have 1 lakh and start subdividing that into 20 stocks, the overall risk in the portfolio starts reducing. So this is why funds form portfolios. This is why individuals, retail clients also form portfolios to basically negate the positive and the negative movements of one stock with the other, and on an average achieve something called as a portfolio diversification. So when you form portfolios, the impact of the idiosyncratic risk of one stock reduces. So for instance, if I have 20 stocks in my basket, and suppose I also have, say, a stock like Reliance, but suppose a negative news comes for Reliance and Reliance, say, tanks by 10% the next day, but the other stocks are up. So what happens is the positive returns of other stocks takes care of that, idiosyncratic negative return of Reliance, and that's the reason why people form portfolios and fund managers form portfolios for that matter, right? So it's essentially to achieve something called as portfolio diversification. This is a very important slide. It tells us the importance of investing in global markets. So before that, I would just like to go to the previous slide. If you see that if you invest more, if you include more stocks in your portfolio, the risk in the portfolio does not diversify below a certain level. So for instance, here the level seems to be around 0.05, where the risk in the portfolio flattens out. So even if I now increase the number of stocks to 100 stocks, the risk in the portfolio will still be around 0.05. So the reason for that is that when you have less stocks, the level of idiosyncratic or the stock specific risk is very high. But if you include sufficient number of stocks in your portfolio, you cannot further diversify away the stock specific risk, and whatever leaves or whatever is remaining in the portfolio is basically called as systematic risk, which is a market driven risk. So when you make a large portfolio, stock specific risk goes out. What remains is something called as market risk. Now, market risk is, for instance, suppose you create a portfolio of 20 stocks, right? That portfolio will basically move along with the movement of the index, which is Nifty in our case, or mid cap Nifty, if you have chosen mid cap stocks, right? So if Nifty is going up, most probably your portfolio is also positive. If Nifty is going down, most probably your portfolio is negative. And that's because your portfolio is exposed to something called a systematic risk or market risk. So beyond a certain level, the market or the systematic risk cannot be diversified. That's very important to understand. The next slide tells us why is it important to invest in multiple markets. Because if you invest in only one market, suppose you were to invest in only Indian markets, the level of systematic risk in your portfolio is higher versus if you invest in, say, developed markets and emerging markets like India. If you form a collection of your portfolio across various geographies, the total level of risk, international risk in your portfolio is way lower, because one country risk negates the other country risk. For instance, if I have India, China, and US in my portfolios, suppose India, China go up and US falls on a certain given day, my portfolio is well diversified because US is just one part of my portfolio. So when if US is going down, India and China are taking care of it. So that's the benefit for global fund managers to form international or global portfolios wherein you diversify your baskets into stocks of different countries, right? There's a very important concept in portfolio optimization called as efficient frontier. Efficient frontier basically means that you are taking two stocks. So as you can see, there's a red dot and a blue dot here. These are basically two stocks. So one stock has a return of 8% and a standard deviation of 20%. So as you can see on my x-axis, there is something called a standard deviation, and on my y-axis, there's something called as return. So this is called as a return risk profile, right? So I can plot individual stocks. Okay, so I've plotted two stocks here. One is stock A, which is red, and the other is stock B, in which the return is higher, 20%, but the risk is also higher. Risk is around 25% in that stock. So two stocks. Now, if I combine these two stocks in different weightages, and as you can see in this table, there are different weights given to these two stocks. So security one is this red dot, and security two is this blue dot. So suppose I start with 0 and 1, which means full allocation to security 2. I basically end up getting the blue dot itself, right? So now if I start weighting the weightages 5% to security one, 95% to security two, so this is one portfolio which is formed, which will have the mean and standard deviation returns like this. The next portfolio which I form is 10% weight given to security one and 90% weight given to security two. So I keep changing the weightages in proportions of 5%. I keep increasing security one by 5%. I keep reducing weightage of security two by 5%, and I end up with various combinations of portfolios which have basically these portfolio returns and standard deviations. Now if I plot these two, what happens is I get this green edge. This green edge or this green curve is basically called as an efficient frontier. It basically gives me the various kinds of portfolio combinations that can ensue, or that can be regarded as an output for these two stocks in my portfolio, right? So these two stocks can be invested in various kinds of weightages, and when I do that, form different kinds of portfolios with different weightages. This is the curve which I get called as efficient frontier, right? So this is a very important term in portfolio management. It's called as efficient frontier. On the x-axis is the risk in the portfolio, and the y-axis is the return on the portfolio. Once again, yeah. How are these portfolios formed? These are formed by changing the weights of the securities forming the portfolio. So in our case now, what we will be doing is we will be taking four stocks. Yeah, we will be taking Facebook, Apple, Amazon, and Netflix, and we are going to assume that the weightages of these four stocks are in this ratio. So 20% weightage given to Facebook, 25 to Apple, 25 to Amazon, and 30 to Netflix. This is an arbitrary vector of weights. Please note, we have not run any optimization yet. We are arbitrarily assigning a vector of weights to this variable called as weights using the vector method, right? So what I've done is these are Yahoo tickers for Facebook, Apple, Amazon, and Netflix. I assigned that to a vector called as tickers, and I assigned the weights to a vector called as weights. So I assume certain weights for now before I start running my optimization. The next step will be to download multiple tickers. So for that, I define a new variable called as PF prices, assign it a null value, and look at what I'm going to do next. What I'm going to do next is that I'm going to run a for loop, which basically loops across every ticker inside this array called as tickers, right? And what I'm going to do is for every ticker inside this array, I am going to use a function called as cbind, which means to the previous PF prices, I am attaching get symbols.yahoo ticker. And I'm also, you can't see it behind, it's gone behind this. Basically, I'm only extracting the sixth column, which is the column for adjusted prices. And I'm basically assigning that and binding that up with the previous PF prices output. So essentially, what we get eventually will be the adjusted closing prices for Facebook, Apple, Amazon, and Netflix together in one table, and that table will be called as PF prices, right? The next thing which we do is we use a method called as ROC, which is rate of change. If the rate of change does not have any other parameter except for the prices, it assumes daily rate of change. So I apply something called as rate of change method, and over that I apply na.omit, which is omitting all kinds of na values from my daily returns. There's one more way of calculating net returns, that is return dot portfolio. And please note that PF returns right now is not assuming any weights, but if you want to calculate portfolio return assuming certain weights, I need to use a function called as return dot portfolio. So return dot portfolio will assume certain return series for each of the portfolio components, and will also assume weights for that portfolio. Weights are nothing but what we arbitrarily decided here or constructed here. So we give both of these inputs into this function called as return.portfolio, and then we use a charting mechanism or a function called as chart.cumulative returns, which will help us chart out the cumulative returns of a certain portfolio. This is very important, guys, because till now we have never used something called as cumulative returns. We've always seen daily returns, right? But here we are using a method called as cumulative returns, which helps me understand the evolution from, say, an initial starting point of my capital to what happens to the portfolio if I keep my portfolio invested over a period of time. So that method is called as chart dot cumulative returns, right? So I've explained a lot of things. Let's go and implement each of these now in my code. So I go back to my code and I go to the section of multiple stocks, 4 stocks in a portfolio. So the first step will be, once again, I'm going to explain line by line. I'm going to assign these Yahoo tickers into a vector of strings called as tickers. So I press Control Enter. And as you can see, a new vector is created called as tickers, right? You can see here. The next thing will be to assign weights to all these stickers. So we have assigned weights to all these stickers. It appears here as weights. The next step will be to start collecting the adjusted closing prices for these 4 tickers into a new variable called as PF prices. But first up, let's assign a null value to this. Let's type pre-PF, sorry, let's type pre-PF prices and see if this is indeed null or not. As you can see, the output is null because right now we assigned a null value to PF prices. And the next step will be to implement this for loop. This for loop is basically looping across every ticker. So for that, we write TKR in tickers. So tickers is the original vector consisting of the Yahoo strings. So for every TKR variable in tickers, we are saying that get symbols.yahoo. We're using that method from quant mod, and we're saying, okay, extract ticker from the original date. We have already assigned the value of date at the first step of this code. Periodicity is daily, auto assign is false. And as you can see, we are saying only extract the adjusted closing price, which is the 6th column, right? So let's implement this, pressing Control Enter. And as you can see that all the prices are available. Now let's see what is in this variable called as PF prices. So I write this command head of PF prices, and as you can see, there are dates, and you have adjusting closing prices for each of these stocks: Facebook, Amazon, Apple, Netflix. Right. The next step will be to calculate returns for these stocks. Right. So I calculate returns for these stocks. Now let's see what is in the head of PF returns. And as you can see, daily returns for each of the stocks is calculated in this variable called as PF returns. The next step will be to calculate portfolio level returns. So it's basically a weighted average technique where the weights is nothing but the vector which we assigned here. So let's run this code, and let's see what do we have here. Head of net returns. Let's see do we have. So as you can see, we have daily level portfolio returns for our portfolio for each of the dates. So this is how we calculate portfolio level daily returns for my portfolio. And the next step will be to chart out the cumulative returns. Let's do it for the portfolio level returns, which is basically into net return variable. And as you can see, this is how my portfolio would have evolved from 2017, right? So we start with 0% returns and we end with 200% returns. So as you can see, if I had invested in these weights in Facebook, Apple, Amazon, and Netflix from 2017 onwards, my portfolio would have actually doubled in return, actually more than doubled, 200% return, right? So this is a cumulative chart. If I want to find the cumulative charts of each of these components rather than just the portfolio, What I've done is I've used on the next line PF returns, which is giving me returns of each of the stocks. So I press Control Enter. And as you can see, I get the cumulative returns for each of these stocks. So the underperformer looks to be Facebook, and the outperformers are clearly the green and the red lines, which are Apple, Amazon, followed by Netflix, and followed by Facebook, right? So if we had not included Facebook in our portfolio, we would have probably gotten a return of around 250 odd percent or 225 odd percent in the portfolio, right? So this is helping us understand which stock is pulling our return up, which stock is pulling our return down, right? So very, very useful chart dot cumulative returns. Any questions, please ask. And I have sort of, on one of the slides, I've sort of given the description for chart dot cumulative returns. As you can see, there are various kinds of things which can be, uh, you know, uh, given as a definition. In our case, we are only using, as you can see, we are only using the price series or the return series rather, but you can give a lot of other specifications. So for instance, you can give whether it's a geometric or an arithmetic chaining method. You can also specify if you want to see the legend or not. You can also specify the color palette you want to use, and so on and so forth, right? So a lot of different arguments you can give, but I wanted to keep things very simple, and hence I only use uh, legend dot location, which is saying that I want to see the legends. What are the legends? Legends are something which is available here. These are the legends. So if I put legend dot location, legend dot lock is equal to false, I will not be able to see this. Yeah. So to understand what is being plotted, this has to be made true always. This is the function called as chart dot cumulative returns. I hope you are able to do this earlier. So the next step is so I've also plotted these out on the PPT. This is how it looks, right? And one more thing, here we are also in the next two steps, we are calculating or we are charting out cumulative returns for the benchmark as well. So we've included benchmark as well along with net returns. We are using a function called as cbind to basically combine two different return series. So let's see how it shapes up. So I have just run this line chart dot cumulative returns, and as you can see, the benchmark return, cumulative return versus portfolio cumulative return. As you can see, the portfolio has far outperformed the benchmark, which has not given me, which has given me, I think, around 40 odd percent on a cumulative basis since 2017. But my portfolio has returned around 200 odd percent on a cumulative basis. So my portfolio has been way better as compared to the benchmark. So this is how I can chart out the portfolio versus the benchmark on a single chart using chart.cumulative returns. And I use the function called as cbind over it. In the next step, we are going to use portfolio analytics to calculate portfolio level beta, portfolio level alpha, right? And portfolio level Sharpe ratio. So we use the same set of codes which we used for the individual stocks. Now we're going to apply that over the portfolio. And as you can see, there are various portfolio outputs here. So if we use table.annualize methods, you can see that our annualized return on our portfolio is around 35 odd percent. The standard deviation is around 20 odd percent, 28 odd percent, and the Sharpe ratio is 1.22 versus the benchmark, which is returning 10%, risk of 21%, and a Sharpe ratio of 0.49. So as you can see, if you compare the Sharpe ratios of the portfolio versus the benchmark, the portfolio Sharpe ratio or the risk adjusted return is way superior as compared to the benchmark. And the alpha of this portfolio versus its expected return is nearly 24 odd percent, right? Huge alpha versus the expected return. So let's quickly summarize these for our portfolio. For that, there's a section of portfolio beta and portfolio analytics. You can name this as portfolio analytics because we are calculating other measures also along with beta. For instance, let's calculate what is going on here. I select these three lines, press Control Enter, and as you can see, the beta for my portfolio is 1.008, and these are the characteristics for the portfolio as well as the benchmark, together, so that you can very easily compare what's happening versus each other. And then if you want to see what is your alpha, which you generate in your portfolio, it's nearly 24.6%. Sharp ratio is 1.107, given that the risk-free rate is 2.5%. Now, this Sharp ratio is assuming that the risk-free rate is 0%, and hence you end up getting a higher Sharp ratio. But if you assume Sharp ratio of 2.5%, you end up getting a slightly lower risk-adjusted return. Right? And then I can just complete the rest of the things, these next three lines of code, and this is how the output looks like for each of the stocks. Yeah? So the last step will be to calculate for each of the stocks what are the annualized returns, standard deviations, Sharp ratios, and how do they compare to each other. So these are the individual level, and the output before that was for the portfolio level analytics. So we have kind of done both portfolio as well as individual level analytics together, as well as the benchmark analytics. The last part of today's code is to understand portfolio optimization. For portfolio optimization, we are going to use a few packages. So if you observe that the first three packages we have already installed, we're going to install three more packages, which are ROI and ROI.plugin, etc., etc. Right? What is this package ROI? If you want to find more information about it, you can go to help and you can just start typing ROI. Right? Or you can go to the package and you can see these three things which we have. So basically, these are optimization packages. So if you want to add constraints, if you want to add objective functions into your optimization function, these are the three important packages: ROI, ROI.plugin.glpk, and the other, which is the quad prog. Yeah. So what you can do is you can install these three very easily now. So I would request you to install these packages, run these libraries. Since it's already installed, I will press no here. But if you're doing it for the first time, it will take you some time to install and load these packages. So ROI-based packages are basically for performing portfolio optimizations. So this is that part of the code. We are going to load these into the library. Yeah. And the next thing is to do that we do is again give a definition DT. Now we are starting the portfolio construction from the 1st of January 2017. The tickers which we are taking, we are adding two more stocks here, as you can see. And then what we're doing is we're downloading prices. So we are now doing portfolio optimization on a new portfolio consisting of 6 stocks now. And once we do that, then we can quickly run the portfolio specifications. So let's do this step by step. So I have loaded these into the libraries. The next step is to define the new date, again stored in the date variable. And we are going to store all the new tickers in tickers vector. We are going to assign null value to the portfolio prices vector, which is basically now would be a vector storing all the closing adjusted prices for all the 6 stocks. And now we're going to run the for loop, which will basically bind all the individual stock adjusted closing prices into the table structure. So it's run. Let's see how this looks like. So there's a head of portfolio prices. As you can see, we have uh, downloaded information for uh, actually 7 stocks. Yeah. So there are these 7 stocks for which we have downloaded information and collected all their adjusted closing prices together. The next thing would be to calculate their daily return. So we use the function called as ROC, and over ROC, we basically omit all the null values, all the NA values rather. And let's see what head of portfolio returns is. As you can see, these are all the returns for each of the stocks. And now we run something called as portfolio.spec. Yeah, so let's see what this does. So portfolio.spec is a function in portfolio analytics uh, package, which basically helps us specify the portfolio. So for instance, if I write portfolio.spec and take the column names of this variable. So column names are nothing but all these FB.adjusted, AAPL, Amazon.adjusted, so on and so forth. So these are column names. So what I'm saying is that I'm telling R that form a portfolio wherein the column names are basically the specifications of the portfolio, right? I assign that a variable port of port F, and then what I do is if I only want to extract and see what are the assets in my portfolio, I write port port F assets in double quotes. Yeah. So for instance, if I say head of portfolio returns, so these are the individual returns. Mind you, we have not run portfolio optimization yet. We are only at the individual stock level. So I now run what is port F. Port F is basically helping us specify the portfolio. So simple portfolio specification, this is how it looks like. The call is this function portfolio.spec, right? The number of assets is the number of columns in this variable called as portfolio returns. So there are 7 assets and these are the asset names. And when I give portfolio assets, I only get the assets which are basically those 7 column names, right? So this is what we get. So let's use that now here. So I run a portfolio specification. I specify the portfolio. So this is the output for that. And then I only want to see the assets part of my portfolio. So this is the assets part of my portfolio. So right now you see a value here, 14.28%. Now please understand that this is nothing but a default weight. Since there are 7 stocks in the portfolio, the weight to each stock is 14.28%. So the sum of that will be basically 100%. So what the normal specification is doing is that it's forming an equi-weighted portfolio and giving each stock the weight equal to 1 by n being the number of stocks or the number of assets in the portfolio. In our case, it's 7. So 1 by 7 is basically 14.28%. So that's the number which is basically the weight which you're seeing. Equal weighted portfolio is being formed as part of a very simple portfolio specification problem. The next part will be to run the portfolio optimization. In this, what we'll be assuming is that we will be assuming certain constraints and we'll be adding certain objectives. So now I use the function called as add.constraint. So here we are adding constraints to the portfolio optimization problem, and we're also adding some objective functions. So let's see what this is. So the first constraint which we add is we say that the sum of the weights should be equal to 1. As you can see, minimum sum is 1, maximum sum is 1. And the weight, which is the type of this, which is weight sum, should be equal to 1. We are adding another constraint saying that the minimum allocation to each of the stock should be 5% and the maximum allocation should be 30%. So we're kind of boxing out the individual weights of each of the stocks, saying that it's in a box where the minimum return is 5% and the maximum return is 30%. So I'm adding constraints related to the weightages of each of the stocks, and then I'm adding the objective. So obviously, the most important part when you run any optimization problem, the first part is constraints of that problem, and the other is what kind of objective do you want to achieve, right? So the objective will always be to maximize the risk adjusted return and hence we add the objective of return. So the mean is added to return, and the standard deviation is added to the risk part as the objective. So we will try to maximize return and minimize risk as part of the objective function. So there are two objective functions here. I could also have given an objective function called as Sharpe ratio, which is to maximize Sharpe ratio. That also would have been possible to give. But here I'm breaking up return and risk and saying that, okay, give these two as separate objectives. And now what happens is the port F variable, if you go back to the previous slide, the port F variable was where the portfolio specification was saved in the port F variable. This was a specification. Now on the next slide, what we've done is we've added constraints and objective functions using the add.constraint and add.objective functions. And now you see what happens to the portfolio specification. So along with the original specification, you have the constraints. So you have weight sum. We have added weight sum. We are boxing the weights for each of the assets and or the stocks in our portfolio. And there are two objectives. The objectives being mean and standard deviation. So we are expanding this specification for the portfolio to be run and to be optimized now by adding constraints and objectives. So let's quickly do this in our R code. So these are the 4 lines of code where we add constraints and add objectives. I'm going to press Control Enter, and let's see how this looks like. Control Enter on the portfolio, and this is typically essentially that snapshot which you just saw on the new portfolio specification where we've added constraints and objectives, right? The last part now will be to actually form and find the weights, form the optimal portfolio, and find the weights of the optimal portfolio. For that, we run a function called as optimize.portfolio, wherein we give the individual returns. We give the portfolio specification. If you remember on the previous slide, we had stored all the portfolio specifications containing constraints and objectives in this variable called as portf. So we are going to give individual stock returns here, and we're going to give the portfolio specification here. Optimization method we are going to give. So we are using the ROI method. And then what we do is we store that output in a variable called as opt_port, and then we chart out the weights using the function called as chart.weights. And as you can see, these two will be the outputs now. The first output will be for the opt_port, wherein we are calling this function called as optimize.portfolio. And these are the weights. As you can see, none of the weights are below 5% or above 30%, because if you remember, those were the two objectives which we added. We boxed out the weights for the minimum and maximum weights for each of the stocks. And here, the objective measure, we get the portfolio return and portfolio standard deviation. So this sort of becomes the optimal portfolio, and these are the optimal weights in the portfolio. So had you invested in your portfolio in these weights, you would have achieved the maximum risk adjusted return in your portfolio. And this is sort of an illustrative version of or vision, or an illustrative tool of how weights are arrived at using chart.weights function. So this is a charting weight chart of weights, wherein you see that there's a floor of 5% for each of these stocks, and ceiling of 30% for each of the stocks. And this is how each of the stocks are getting weightages of. So as you can see, Facebook, Google, Netflix, and Nvidia are being assigned as the lowest weightages, which are 5%, and you have higher weightages for Apple, Amazon, and the other company, right? So this is how you run portfolio optimization, and that's how you get the optimal portfolio characteristics. Let's quickly run this in our R. The next thing to be done is run this optimize.portfolio function. So let's do that. And then we see what is the output from there. So this is the output of that, which we just saw in the slides. And if you want to see the weights here in the plots section, you can run chart.weights, and you see all the weights charted out in the plotting area. for each of the stocks. And the last feature in portfolio optimization is to extract the efficient frontier. For that, we use a function called as extract efficient frontier, in which we give the portfolio specification. We give what is going to be the risk of the portfolio that's specified through standard deviation. We say maximum number of stocks in the portfolio will be 50. Risk aversion parameter is null. So this is a function called as extract efficient frontier, which is part of the portfolio analytics library or package, which can be used to extract the efficient frontier. And then we can chart it out using chart.efficient frontier, as you can see this. And the optimal portfolio, if you remember, was that one single optimal portfolio. So along with the efficient frontier, which was a collection of portfolios, if you remember that curve which we had a few slides back, so that is the efficient frontier. And the optimal portfolio is a single point which gives us the optimal portfolio. The way it looks like is this. So when I plot the efficient frontier, it will look like this. And the red dot here is the blue dot here is the optimal portfolio, which can be very easily found out using this function called as, again, chart dot efficient frontier, right? So it has various parameters, very, very complex function. So what I've done is, on the next slide, I've given a view of what each of these parameters are, right? So for instance, the number of portfolios to plot the efficient frontier is n dot portfolios. I use 50 portfolios to plot the efficient frontier. You can set a limit to the x-axis, y-axis using these things. This is match.call, which in our case we assume to be equal to standard deviation, which is nothing but the string name of the column to use for the risk. In our case, the horizontal axis is always standard deviation, which is the risk of the portfolio. And then you have the other parameters also. You can also specify the risk-free rate. You can see whether the tangent line, which is basically the line, the straight line which connects the risk-free rate to the optimal portfolio dot. So that's the line which is also called as a tangential line, or the tangent line. So if you say tangent dot line is equal to true, you will be able to see the tangent line. So if you see, this is the tangent line where the risk-free rate is 0, and you are basically combining the RF, which is 0 in our case in this chart, and you're combining that with optimal portfolio. And the straight line which connects these two is basically called as a tangent line. And this is my efficient frontier. These are the individual stocks where they lie in my risk reward charting, and this is the efficient frontier. So let's just plot this out as the last step for today. So first of all, if you remember, we have optimized the portfolio, charted these weights out here. The next step will be, and the final step will be, to find the efficient frontier. So let's do that. Now, the output of the efficient frontier is stored in a variable called as EF. Yeah. And now we're going to chart out that EF variable using this. And as you can see, this is the output. Assumption of risk-free rate right now is 0. And as you can see, there's a tangency line, or a tangent line, which connects risk-free rate 0 with some sort of a optimal portfolio. Optimal portfolio is not yet visible here, but we can certainly add the optimal portfolio using, again, chart.efficient frontier. So if we use that, if you see, there's this blue dot which appears, which is the optimal portfolio. Now, the last thing to do is to assign risk-free rate. So now we assign a risk-free rate of 3.5% and redo the efficient frontier. And as you can see, the efficient frontier now does not start from 0. It starts from a non-zero risk-free rate. So this is the daily risk-free rate, which is 3.5% divided by 252. And then you can very easily chart out the reward to risk matrix of this, of the optimal portfolio versus the individual stocks. And finally, you can plot out the efficient frontier weights using chart.ef.weights. And this is very, very useful because for each type of portfolio, I have an illustration of how did the weights vary for each of these stocks. So this is a very useful function called as chart.ef.weights. So for every portfolio in my efficient frontier, I can see what the weights were for each of the individual stocks. Yeah. So I would like to stop here. If you have any questions with regards to whatever I've done till now, you can ask me. I will be soon sharing the video with you and the slides as well. So please go through this exhaustive deck, which contains how to, you know, form portfolios, construct portfolios, how to do single stock analytics, how to do portfolio analytics, and then eventually how to optimize your portfolio and arrive at something called as optimal weights. All of these we have covered in today's session. In the next session, we are going to cover something called as risk analytics, where we're going to use portfolio risk analytics to look at various kinds of risk measures for the portfolio. Right? Thank you for joining us, and and please go through the content which we'll be sharing very soon. Thank you, everyone. Okay, Jay. Question from Jay: how can we retrieve Indian stocks data on R? Right. So you can. Uh, okay, you can very easily go to Yahoo Finance. So under Yahoo Finance, you can do a quote lookup. So suppose you want to find what is the ticker for Nifty. I start typing Nifty, and the ticker for Nifty is the hat NSCI, right? Suppose I want to find the ticker for SBI. I start typing SBI, and then or I start typing State Bank of India and see what you get as an output. The code output is all these. So uh, the SBI which trades on NSE is called as sbin.ns. So that's your symbol, right? Uh, I shall share all these symbols with you, but if you go to stocks in India, you should be able to see all the symbols, right? So I can share this link with you, which will be useful for you to uh, get all the Yahoo tickers for Indian stocks. So this is the URL for that. So all these different kind of stocks you can very easily look at: SBI, Indian Oil, Indiabulls Housing, Nestle, Coal India, etc., etc. You can look at various things related to India portfolio. So thank you guys for joining us. I will see you guys very soon again. Thank you.